Hi, ladies and gentlemen. This is Kevin Martini with the Kevin Martini Group at DNJ Mortgage, and this is a special edition of the Weekly Martini. The two issues that seem to be on the tips of the tongues of every single buyer and seller recently is, first, what's happening with prices? Are we headed towards another bubble, Kevin? And the second is what's happening to interest rates. With rising interest rates, well, you know, Kevin, prices will start to crash. Well, let's start with the latest home price expectation survey, which came out a couple weeks ago. As a primer, this is a quarterly report done where they survey the nationwide panel of over 100 trusted economists, real estate experts, investment and market strategists. What these experts did is they looked at and said, what is the pre-bubble number? What happened during the bubble? And they redefined the bubble. What happened during the bust, and what happened so far from the bottom to where we are today, and then finally, what to expect next. Ladies and gentlemen, normal appreciation was 3.6% on an annual basis. During the bubble, obviously that shot way up, more than double. During the bust, there had to be a correction. And right now, we're 4.3% back from the bottom. And what they're projecting going forward over the next several years is that the annual appreciation is going to be about 4.1%. Let's break that down a little bit. These experts, and I agree, we're going to finish out about 5.4% this year. Now, I know that some of you are going to say this. Calm down, Kevin Martini, and wait a second. In my particular neighborhood, prices are different. Ladies and gentlemen, this is a national average to get a feel for what's taking place in the market. And basically, once we clear out all the inventory and the market gets back to normal, the country will look a little bit normal also. The projections are that prices are going to start to stabilize. So from January 2013 to 2014, that's what they expect will be the annual appreciation. Now, over the last 30 years, there's been 4 times that interest rates spiked. And when they spiked dramatically. And on that spike, each spike was more than 1% over during the period of time. Look at the bottom of this chart. What happened to house prices during the spike? Well, ladies and gentlemen, they didn't go down. House prices went up. Interest rates going up, prices have to tumble, Kevin. Well, no, not necessarily. As a matter of fact, the last 4 times interest rates did a spike, prices went up. That's historical evidence that you can show on this slide. Now, I'm not going to say that this is going to take place. You can see there's a variation between 1% to close to 11%. Ladies and gentlemen, it's not just interest rates that determine price. It's the amount of supply, the inventory, it's where the economy is, it's where unemployment is. And each one of those time periods, the fundamentals were materially different. All I'm saying is there's no guarantee that because interest rates are spiking upward, that prices are going to spike downward. There's no historical evidence that that took place. But back to January of last year, where interest rates are so you can get some sort of historical perspective on them. Now let's take a moment so I can give you the Kevin Martini perspective on what happened and just took place. I have 3 different bands here. This is going from the beginning of this year. The beginning of 2013, for the first 6 months of this year, interest rates usually bounce in bands. So between 3.25 and 3.75, that is the band. It bounced around that for about 6 months. Then it jumped into the blue band. And many people thought it would bounce around that blue band for about 6 months before it jumped into the green band. But ladies and gentlemen, it only spent about a month in that blue band and then jumped. So we actually jumped over one band into where we are now, between 4.25 and 4.75. And that's where it's bouncing right now. So usual interest rates bounce around within bands. We pretty much skip the band. That's why there's some excitement about the spike up in interest rates. But what we need to realize is that the next band is 4.75 to 5.25. When are we going to get there? Well, all 4 major analysts, Fannie Mae, the National Association of Realtors, Freddie Mac, and the Mortgage Bankers Association all believe by this time next year, we're going to be in the next band, bouncing around between 4.75 and 5.25. Should somebody wait if they're thinking about moving up? The answer is no. Should somebody wait if they're thinking about buying the first house? The answer is obviously no. Prices are going to continue to rise at a slower pace, but they're going to continue to rise. And interest rates are going to continue to rise a little bit faster pace. So what should you do? You should go ahead and buy now. You see, over the last four decades, 1983, 1993, 2003, and 2013, what would be a monthly payment on a $250,000 mortgage? Now, we're looking at principal and interest here only. So even though you may have waited to buy, yes, you're paying more than your friend did 6 months ago. However, let us compare 83, 93, 2003. So from a historical perspective, ladies and gentlemen, a buyer buying a home today is still doing really, really, really well. My name is Kevin Martini, and this has been a special edition of the Weekly Martini. If you need or you know someone that needs trusted mortgage advice, please invite them to give me a call at 919-274-3700. For trusted advice, for great mortgage rates, and stress-free on-time closings, please give me a call at 919-274-3700. Thanks for watching, and please share.